Hi, I hope you're gaining some value in this course. Now, what is liquidity? Now, liquidity, the whole summary of liquidity is money. It is your money in the market. You know that small money that you're trying to protect. That's what we call liquidity. But in the simplest and the babblest levels of liquidity, liquidity is your stop loss, what you set your stop loss to be, like your how much you want to lose in the market is your liquidity and your pending order. Example is when you have higher sorry, let me draw it very well. When you have higher high, higher low, higher high, higher low, higher high. Normally, don't forget, right? You want to place your long position here, put your stop loss here, and your take profit here. Now, all these areas down here are signaled as a form of liquidity because they are money that you're about to lose in the market. Normally, that's why you hear people tell you, oh, that's buy or sell side liquidity. These are all liquidity, or it can be your pending order you set in the market. It's all a summary about the stop loss or the money you're ready to the way you're ready to lose money, that's the way other people are also ready to gain that money you're about to lose. That's the way I understand liquidity to be. Liquidity is a form of your money that you're ready to lose in the market. Nobody knows when liquidity is about to be created. Nobody knows when liquidity will be created. We all know that markets can act in a very funny way, but we can also learn how to use it to our advantage, which I learned gradually and I'm still also learning and I'm sharing with you from here too. Now, for an example now, we can see that market did what? There was a liquidity grab here. Can you see that, right? There was a liquidity grab here. Now, now your own imagination, okay, let me set a long position. Imagine you place your trade here and you put your stop loss down here, right? An example, imagine you bought your shoe that is on your leg now. You bought it for $50, right? And let's assume you bought it for $50, and out of annoyance, out of market now, it now dropped down to $30. Indirectly, you have lost $20 because you would have actually just, oh my god, if I had known, I would have waited for this thing to get to $30 for me to take to buy this shoe, and it's at your loss because you just lost $20 of your money before market started going on its momentum for the price to keep going higher and higher and higher. And you'd have wished that you had bought lower and you waited for the market for the shoe price to increase to gain more for the shoe in case you want to resell it. Now the same scenario goes for a sell momentum. Let me find a sell for you here. I just give you an example now for a bullish momentum on how it takes place on a bullish momentum, and also is signaling our stop loss area. Now imagine if now, let's assume this is a form of liquidity. That's why you hear the word inducement. That's why you hear the word inducement or liquidity. Still the same thing, inducement. Now imagine you took your trade from here. You took a sell position from here. Your entry was around here, and you set your stop loss here, and you targeted down here to sell. Like assuming an example now, you have a t-shirt and you wanted to sell the t-shirt for $100, and all of a sudden as you're about selling the t-shirt, the price just increased. Like it just increased. You're like, what's going on? It just increased to like $50. So instead of selling that shirt for like $100, the shirt increased. You already sold the shirt though. I'm not saying you haven't sold the shirt. You have to sell the shirt. Well, I use the word. Let me use the word sell the shirt. But now the worth of that shirt is not no longer $100 because you're like, oh my god, I need to sell this thing off. But instead you have to add more money. You have to add more money up here and sell it for that 150 to be able to sell it down. Because why? The worth of that shirt is not worth $100. Instead it is worth $150. So instead you will actually have to add more money for you to sell that shirt for $150. Do you understand? You are selling that shirt for $100. That is your entry. You are entering the market at $100. But market is like, no, I'm not ready to go down. It took you in. It took you in. It added more money. It took you in. It took more money from you. That no, I'm not ready to go there. I need to add that gain more momentum. So it's like you're selling a shirt of $100. You're about selling a shirt of $100, and the market that you're selling the shirt is like, no, I'm not ready to take the shirt. It went up again. It took you in, and like $50 gain. You have to add extra $50 to the market to push you down to be able to sell. So I hope this is very simple for you to understand. It's also the same way of placing your own stop loss. The stop loss that you place in the market, don't forget that you're also risking money, that you want to risk something to gain something, right? So it's the same thing. You're also going to risk something. Like now, you'll be so angry that you have to add extra $50 to the $100 which you did not plan for. The same way for a buy momentum, you'll be like, oh, I wish I sold, waited patiently for this thing to come down more for me to buy this market at this level. The same thing here. I wish it's like a slogan. You buy low to sell high. You sell high to buy low. Do you see it? Buy low to sell high to buy low. So the same situation here. No one knows when liquidity will take place. Nobody knows when to take place. It's market to do its thing for it do how it wants to behave, it will behave how it wants to act. But your stop loss or your pending order is where liquidity is. Some people actually say, oh, different type of liquidity, we have equal highs and equal lows. That's also a form of liquidity. That's your buy side, your sell side liquidity, also a form of liquidity. But it's somewhat the overall summary for beginners is just your stop loss and your pending order, which categorized as a form of liquidity. So I hope this can be very beneficial to you. Let me find that example to you for you again. There's a liquidity. You can see here also there was a liquidity grab here. You can see you wanted to buy you bought a shoe. You bought a shoe for $50, right? And it's so annoying that as you're there, the thing just oh my god just went down and it came down to $30. And you know it's so annoying. Oh my god, I should have waited. So the goal is buy low, sell high before it's not going to sell the price the increasing. So it can take you in the form of your stop loss being violated or your pending orders being also violated. I hope this video was impactful to your trading. Thank you so much.